My name's Depesh Patel, editor at Trade Finance Global, and today we're talking distribution from ITFA Abu Dhabi. I'm joined by Khilola Turaeva at Bank of America. Khilola, welcome to Trade Finance Talks TV.
Hello, Depesh. Great to be here.
Thank you, and thank you for joining us here in Abu Dhabi. So, quick introduction, who are you, where are you from, and what do you do?
Sure. I'm Khilola Turaeva. I'm managing trade risk distribution function for EMEA region at Bank of America. We provide opportunities to distribute and manage trade finance risk among investors and meet trade credit demands of our clients.
Thank you very much, and I think that's going to be a very timely, important part of this week's conference. Could you start by giving an overview of how the landscape of trade asset or risk distribution has evolved over the past few years, especially in light of some of the increasing macroeconomic challenges we're seeing?
Sure. In the past few years, trade distribution market has been very active. Its strategies had to constantly adapt to ever-changing environment. I would highlight three main areas where I observed most significant changes. The first one, I think it's a legal and regulatory environment. Legal framework of risk distribution has evolved dramatically. Thanks to ITFA and BAFT, industry standard document like Master Risk Participation Agreement has been updated. And most importantly, there is a continuous effort to reflect recent trade finance changes in those documents as well. IBA transition caused another big legal review of the underlying bank-to-bank documentation as well as client agreements. So the second biggest development is evolvement of the investor base, investor market. Currently, banks predominantly involved in risk distribution market. However, in the past few years, we have seen that non-bank financial institutions are more and more attracted to take part in financing of the cross-border trade and supply chain finance that offers diversified, typically low risk and short-dated cash flow. I have also noticed that not all non-bank financial institutions need transformation of the trade assets into their kind of capital market products like notes. They do accept more traditional ways of risk distribution via master participation agreements, covering trade-by-trade flows, and in general they become much more knowledgeable about the trade. And the last very hot topic at the moment is digitalization. And digitalization is not only a big topic and focus for the primary origination market, but also for trade asset management. The most demanding change is driven by the desire to automate very manual risk distribution processes. However, some marketplaces and fintechs, they would like to go even further and propose automation of the marketplace, which is very innovative and potentially can transform risk-sharing industry completely. However, at present, direct bank-to-bank partnerships, remain essential for trade distribution business that relies on wider financial institution, non-financial institution strategies of the bank, relationships built over the year, and previous experiences.
Thank you very much. That was a really good summary. We have the legal changes, the IBOR changes, and the MRPA changes. We have the changes to the investor base, and of course digitalization. I guess, how has this evolving landscape changed how Bank of America handles risk distribution, and what are those key drivers?
In the current evolving market, ensuring diversity of investor base and stability of appetite is one of our main areas of focus when it comes to risk distribution. Given our global footprint, we continue to broaden and enhance our investor franchise. We continue to originate trade finance business and support our client needs while increasing velocity of the trade portfolio. The non-bank financial institution is also a big part of our wider cross-sell relationship play. And we do recognize importance for those non-bank risk sharers to get access to the dynamic trade assets. In the recent years, we have developed and we are currently working with a number of institutional investors across different regions, across different risk distribution desks at Bank of America. In terms of driver, the key driver for risk distribution, I think, is in ensuring the continuity of the financing, especially for products like supply chain finance. Given the ongoing nature of the supply chain finance facility, constant capacity creation is extremely important to ensure growth of the supply chain finance program. Single platform integration for the buyers, new supply onboardings, while keeping a very flexible syndication structure in the background. And obviously, digitalization is another big change driver. I think that all the efforts that industry is putting into digitizing of trade finance will definitely create more opportunities to share the risk among the investors in future.
Khilola, what developments in trade digitalization have had the biggest impact on trade asset or risk distribution?
Bank of America's trade transformation strategy is to recognize and appreciate the complexity of the trade ecosystem. The launch of Bank of America's Cash Pro Open Account Automation was recently unveiled at the Cybers event in Toronto. So Open Account Automation goes right into the start of the trade cycle. And it is the simplest and easiest way to automate open account trade, which is, according to 2018 ICC report, represent 80% of the merchandise trade flow. It is powered by the advanced trade processing platform that facilitates seamless and real-time exchange of the information between the parties in the trade transaction. It kind of automates entire open account process, from purchase order upload, logistic data capture and mapping, to supply pay. This solution provides clients with this unique end-to-end visibility of their financial and physical supply chain finance on one platform, while helping further enhance their operating efficiency and unlock wider procure-to-pay benefits. And here comes the link with risk distribution. Buyers may provide an option for early repayments to the suppliers, which can be bank funded, creating a supply chain finance facility, which ultimately can be distributed if required. Much like other parts of the trade finance business, risk distribution involves many parties and different form of communication, driven from paper to other electronic communication. So Bank of America has undertaken a wider transformation approach, working with the key tech providers to digitize the paper and enable digital connectivity between the parties involved in trade. So ultimately, taking out paper from the deal origination process will mean that risk distribution will be less paper heavy.
That was Khilola Turaeva from Bank of America joining us at ITFA Abu Dhabi. Khilola, such a pleasure to have you on Trade Finance Talks TV. Enjoy the rest of ITFA.
Thank you very much. It was a pleasure. Thank you.